And welcome to On the Money. My name is Cynthia DeFazio, and I'm joined today by Ryan Wheless. He is the founder of Allied Wealth. Ryan, how are you today?
I am doing so good. It's once again a pleasure to be here with you.
I'm so excited to have you in the studio because obviously the show has been doing so well. You've been receiving one call after the next. People want to know about the blueprint. So let me ask you, what has life been like in the office for you lately?
It's been crazy. That's why Matt and Pete aren't here today.
Yeah,
They're there at the office running appointments and actually delivering financial blueprints to people that called in and requested them. But what's really awesome is that our viewership is very engaged in what we're doing, and they're taking advantage of our offers, and they're learning. The people that come in are learning so much about their portfolios, about how to take Social Security the right way, how to reduce taxes, and we're getting an outpour of like thank yous, and it's just it's very, very fulfilling. Fills my cup, as I like to say, to be able to help, because that's what we're here to do.
Absolutely. And you have such a passion for helping people retire with confidence. Ryan, where does that come from?
It just comes from seeing people that got wiped out in 08, 09. I was in flight school myself back in the 01, 02 crash. I had $100,000 in student loans, had no aviation career ahead of me, and couldn't get a job I wanted to. So I felt that, experienced that, and then I saw people experience it some more in the 08, 09 crash. And I just saw an opportunity to really learn this industry, and I fell in love with it. I mean, it's just, I'm a financial geek. I am the biggest nerd dork you've ever seen in your entire life when it comes to, portfolio numbers and retirement numbers and how to get the most we can out of somebody's retirement. I love doing that stuff. And then, it's like Peter says, if he was here, he says, when you love doing something, you never work a day in your life.
That's true.
And I don't really work. I mean, I do what I love doing, right? And so it just became a passion of mine. And then when I was able to help people like in 08, 09, our clients didn't lose 40% of their life savings in the crash. And just the appreciation and gratitude of our clients coming our way from that is it's awesome. Like I said, it fills my cup.
And that's reward enough. When you know that you're serving others and it's beneficial and they're feeling confident and happy, that's peace of mind, not only for them, but for you. You can sleep well at night.
No question about it. I mean, there's no question about it. Cynthia, I had a lady come in, this is years ago, and she was 58. And she wasn't all there, but she worked at the post office her whole life. And she didn't have any money saved. And she was referred into me by another client, and she came in to sit down and talk to me. And we were trying to talk about what to do, and I'm like, you have no money. I want to do something here, but I can't figure out how to help you. And then it dawned on me, oh, you've been a postal worker for like 35 years. She says, yeah. I said, well, do you know that you qualify for a pension from the Postal Service? You get 80% of your average 30 years as a pension guaranteed to you for the rest of your life. So I know you're tired. I know you're not feeling good. But I beg you, I need you to stay for 2 more years. If you stay for 2 more years, you get that pension. And that lady, to this day, sends me a Christmas card.
Aww.
There's no opportunity for her to work for her. Her money's in the pension. She gets her paycheck. She's happy. But to this day, she sends me a Christmas card. And I didn't make any money off that transaction, but that's not what it's about for me. I believe if you help enough other people in life get what they want, you're absolutely going to get what you want.
Yeah, it's about putting others first.
No
and
question.
Isn't that the golden rule? Treating others like you want to be treated, and it comes back to you.
It
and
absolutely
it shows.
does. It absolutely does.
Well, Ryan, I want to talk to you. Obviously, there's something that we've gotten a lot of questions about because we've talked about this on one of the other shows, the Reg 35D1. Can we jump into that? Because viewers are asking, what is that? Can Ryan please explain it in more detail?
We actually got some hate calls and some hate mail on this thing. They're like, that's not how it works. But yes, it is. So when Reg 35D1, it basically regulates mutual funds. And so if you have a mutual fund and you call yourself a large cap fund, that means you invest in big companies, Apple, Microsoft, Exxon, Chevron, big companies, large capitalization companies. Well, what happens is you're required to invest 80% of the fund's money into large cap stocks at all times. At all times.
At all times.
All times.
No matter what.
So fund managers aren't stupid. They saw the 08, 09 debacle coming. But because they're handcuffed, they couldn't sell your money out of the markets. They had to stay invested because of Reg 35D1. And so many people don't know this about mutual fund structure. They think they have a guy and the guy moves it around. Well, no, that's not how it works. The mutual fund manager must stay invested in whatever the fund type is, large cap, small cap, mid cap. If it's a large cap fund, they have to be invested in large cap stocks 80% of the time. So when they do see that freight train of a market crash barreling down the tracks to them, they can't get you out of the markets. They have to stay invested. And so many people don't know that about mutual funds. It's mind-boggling.
Okay, so were those the advisors that were hiding under their desks that didn't answer the phone?
They're the ones that tell you to hang in there. The market always comes back. It's okay if you lose money, which is absolutely not okay to lose money, by the way. I need more time. Just bear with me.
Yeah.
They have to say that. They can't say anything else because of what they have your money invested in.
So what about the advisors that say it's a paper loss?
It's not a paper loss. And here's how you know it's not a paper loss. If you're doing the 4% rule thing, I don't do that rule. We do better than that in our office. But if you're doing the 4% rule and you've got $1 million portfolio, you're taking out $40,000, right? 4%. Well, if you go down to $500,000 and you're still taking out 4%, right? Well, 4% of $500,000 is now $20,000.
Yeah.
So where's the paper loss? I just lost half my income. That's a loss.
That's a loss.
That's an absolute loss of money. Sure. So watch it's just a paper loss. It's not just a paper loss. If you had to cash those investments in right now today, you had an emergency. That's where you are. That's a fact. It's not a paper loss. So don't ever let a financial advisor tell you that again.
Another thing to talk about, Ryan, obviously, is that Allied Wealth is independent. So let's talk about why that's important versus some of the big box firms, if you will.
Well, it's super important. And this is another thing like 35D1 that people don't know about. The big box stores and the bigger name companies out there, we know who they are, and they're in the strip centers and they're at the banks and that sort of thing. The people that work there they have a broker's license. They're not really advisors; they're a broker, and they broker financial products and to be mutual funds and variable annuities for commissions. That's their business model. All right, and so to that end, they're given a set menu of products and services they can offer the people that walk into the door. And there's oftentimes things that are not on that set menu that might put you in a better situation, but they can't tell you about it because their bank they work for, or the big box company they work for, won't let them do it. It's not on that. It's not on their list. And the reason why that is these big box retailers and the banks, that sort of thing, if they push this fund, they get back in money, and the back in money they don't have to disclose to you. Well, so in my world as a fiduciary advisor, we have to disclose it to you. You know exactly what you're paying, and we're required by law to make sure you know what you're paying, because our regulators will come in and audit us and say, Ryan, calculate your fee for Ms. Jones's account, and furthermore, justify why you charge Ms. Jones that fee, right? So you have to be completely transparent on our side of the business, and to that end, we're not tied to any menu, right? There's nobody in my office that comes and says, you got to push this fund or you got to push this, whatever it is. That's not how it works. We go out and find the best products and services we can for our clients. We put them in those products because of the long-term vested interest in their success.
Well, Ryan, I know you have a very special offer to present to the viewers at home. Let's talk about what that is and then open the phone lines.
Yeah, so we offer a financial blueprint or a retirement blueprint. And what that allows you to do is go out into retirement and spend money with confidence. It allows you to go out and give less of your money to Uncle Sam in the form of taxes and keep more for yourself. It allows you to reduce your risk. It allows you to reduce your fees, increase returns in some cases, and it's all free. It's complimentary. We don't charge for it whatsoever, right? So take advantage of it. Call 844-944-7555. You see the QR code there on the bottom of your screen. You can click that QR code, and that'll take you to our website as well, and you can contact us that way.
And I love that it's complimentary. Thank you so much, Ryan. To the viewers at home, the phone number to call is on your screen. That number is 844-944-7555. We know you have a lot of questions for Ryan about how to design and plan your blueprint. He has the answers for you. Again, we have to take a very short commercial break. That number is 844-944-7555. We'll be right back momentarily.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
And welcome back to On the Money. My name is Cynthia DeFazio, and I'm joined today by Ryan Wheless. He is the founder of Allied Wealth. Ryan, a wonderful show that we're having, obviously talking about very important topics. We jumped into the Reg 35D1 right off the bat right there. But
that's a good one.
It is a good one. It really was. But with this segment, I would love to talk to you about the 3 ways to invest. What would those be, and what's the difference between them?
Cynthia, there's a lot, obviously a lot of different ways to invest, and what we're going to kind of drill down here on, and I think this is important, is I want people to understand how they're invested.
Okay.
Right? And there's 3 basic ways. There's what we call the passive approach. There's what we call the active approach. And there's what we call the tactical approach.
Okay.
And they're all 3 uniquely different. So the first one we'll start on it's pretty easy. It's passive investing, right? I buy an index fund. I buy the S&P 500 index fund. And I put money in there, and I don't look at it again. And if the market goes up 20%, I get 20%. If the market falls down 30%, I lose 30%. I get whatever the market gives me, all right? And so there are times in history when you couldn't beat passive investing. But when we turned the corner in 2000, you had a 13-year period from 2000 to 2013 where passive investing had 2 losses. One was about 47%, the other one was about 55%. All right, so you had 2 periods of major losses,
yeah.
All right, and a 13-year period of 0 growth. So imagine retiring in 2000, taking money out of your portfolio using a passive portfolio and getting 0 growth for 13 years.
Wow.
You don't have as much money as you started with. It's not possible,
no,
right?
That can be devastating.
So there's a place for passive investing, and I believe that very strongly. And I think it's one of those things where if all you've got is a 401k plan to invest in, you're going to do that in a passive manner because 401k plans are so watered down anyway. All they allow are passive index funds. And so when you're adding money to your 401k each month, you can dollar cost average it to the market, and that's a great way to passively invest. When you get to retirement, I don't think many people out there want to stomach losing half their life savings, and that's exactly what being passively invested can do in retirement. And the interesting thing is when people do take advantage of the blueprint, we tell them, hey, your portfolio is passive, or it's active, or it's tactical. We go into great detail with that. The next way, Cynthia, is what we call active management. And active management is basically you've got a mutual fund manager who's trying to beat the stock market, all right, in some capacity. So you've got the market versus the manager.
Okay.
Well, what happens is the manager goes down to the Apple store. I mean, maybe it's Christmas time. And he walks into the Apple store, and he looks around, and he's like, well, I can't get an appointment at the Genius Bar. Products are flying off the shelf. It's standing room only in the store. There's so many people here, right? I think Apple's going to have a really good Christmas and a really good quarter. So I'm going to go back to my office, and I want to buy Apple stock. And that's what they did, right?
Okay.
So 3 months later, they go back to check up on the Apple store, and now they go in and they say, okay, I don't see as many people in the store. I don't see products flying off the shelf. I can get a Genius Bar appointment, right? And they say, okay, I'm going to go back to my office, and now I'm going to sell Apple stock.
Yeah.
All right?
Yeah.
And that's what they're trying to do. They're trying to buy and sell stocks based on fundamental research, sometimes just a hunch,
Yeah.
right?
Yeah.
Of, that I'm going to buy this and it's going to go up in value. And that's called active management. And the reality is you have a manager trying to beat the market. And we call that relative performance, right? So their performance is always relative to the market return. So if the market's up 10% and the manager's up 15%, who won, the market or the manager? Right? The manager won.
Absolutely.
Okay, so you want that, right? So what we say is that, all right, look at it the other way. If the market's down 40% and the manager's only down 37%, who won? The market or the manager? The answer is the manager won.
Yeah.
He's down 37, the market's down 40.
Yeah.
Right?
Yeah.
I don't know why you're calling my office complaining. I beat the market.
Yeah.
Right? Well, the reality is the folks at home don't know that that's how it works.
Wow.
Right? And yeah, he beat the market or she beat the market, but the client's still down 37%. Right? On a $1 million portfolio, it's $370,000.
Wow.
It's insane. And so many people don't understand that's how a lot of active management is handled. And it's interesting, too, that only 20% of active fund managers beat their benchmarks every year.
Really?
Which means they fail 80% of the time.
Wow.
So would you want to have some money invested in something that fails 80% of the time?
I'm going to go with no.
I'm going to go with no. Right? But again, Cynthia, it's the education. So many people don't know how this stuff works, and it's just mind-boggling to me that you have oftentimes your largest amount of assets is your 401k or IRA, and it's invested in this stuff, and you don't even know it.
Wow.
You don't even know it, right? So the last way is my favorite thing.
Okay.
And it's called tactical money management.
Okay.
And tactical money management is very different. And it's different in the sense it's misunderstood. Okay? In tactical management, what we're trying to do is first mitigate downside risk, and second, get return. All right? So what happens is in a tactical portfolio, we're only designed to get about 70 to 80% of the market's performance. All right? So if the market's up 10%, all right, and you're only up 7, you're going to call me and go, hey, I'm paying you guys to manage my money. You can't even beat the market.
Yeah.
Right? And what's going to happen is if you don't understand tactical management and what it's designed to do, you're going to start to lose confidence in us and your portfolio, and you may go jump ship at the wrong time and find yourself prey to a financial advisor who's not a fiduciary, by the way.
Yeah.
All right? So the reason why it's only designed to capture 70 to 80% of the upside, it's also designed to capture no more than 30 to 40% of the downside.
Okay.
So you're giving up some of that upside run for the potential, mitigation of downside losses, right? And we like that, Cynthia, for retirement, especially for taking income, because you can take a higher distribution rate than the old 4% rule doing that, right? So you can actually get more money out of your portfolio.
Yeah.
And we understand that to make retirement work, you don't need great returns. What you absolutely must do is avoid great losses.
Okay.
And we're able to mitigate that downside using a tactical portfolio. So those are 3 basic ways that you can manage your capital for long-term success. And the interesting thing is none of them wins 100% of the time.
Yeah.
There's times passive will beat tactical. There's times tactical will beat passive. There's times when active may beat all 3 of them, right, or the other 2. So, we can build you a portfolio that has a little bit of passive and some tactical. We call that core satellite, by the way. Works really well. But we don't typically do a lot with active stuff because I just simply don't believe in putting my clients' money in something that fails 80% of the time.
Absolutely. And I'm glad that you brought that up, Ryan, because one of the viewer questions says, Ryan, the market is up 15%. Why am I only up 9%?
Yeah, and so that could be something that you're in a tactical portfolio that's not designed to capture all that upside return, right?
Yeah.
And it's important that you're communicating with your advisor to remember that. I mean, I've got clients that come in every single year and they go, okay, Ryan, it's that time of year where you have to tell me why we're doing all this stuff again.
Yeah, yeah.
And I have to re-educate them through the whole process, which I love doing, and I'll pull one of the junior advisors in and say, come in and watch this, you need to see this, right? But it may be that you're tactical, but it may not be. It may be that your portfolio is benchmarked or is a 60-40 portfolio, okay? So if the market's up 15, that's all market. But if you're in a balanced portfolio, that means that 60% of your money is in stocks, the other 40% is in bonds. So you can't compare a portfolio that's 60% in stocks and 40% in bonds to the stock market.
Yeah.
Why? Because you're only getting 60% of the return of the stock market, right?
Yep.
So what you have to do now is go look at the bond market return. So what's the bond market return? The reality is, in this example here, we've got the market's up 15%. Well, if I say, okay, 15% of my return comes from the stock market, right? Well, okay, I'll take 40% of that. The weight is 6%. And then I look at the return of the bond market. The weight of that 60% in this analogy. So the total portfolio is up 9%. So if the market's up 15 and you're in a balanced portfolio and you're up 9%,
Yeah.
you're exactly where you should be.
Wow.
But so many people don't know that, and they don't take the time to understand what they should be looking at. It may not be the stock market. It may be the bond market. It may be both. But understand that just because the market's up 15% doesn't mean you should be up 15%. There's reasons why that's not the case. You could be in a tactical portfolio. You could be in something that's less risky in the stock market.
Yeah.
So understand your benchmarks and understand what your money's invested in, folks.
Absolutely. Well, Ryan, this is the perfect time for us to open the phone lines. Would you agree?
Absolutely. And this is where we're offering our financial blueprint and in our retirement blueprint. And this is one of these things where, folks, I say it time and time again, if you are someone who has worked hard your whole life, has built a nest egg, and you absolutely want to get everything you can out of your retirement plan, your 401k, your Social Security, your pension, and live the richest possible life you can in your golden years, take advantage of the offer. It's totally complimentary. We don't charge for it. It's something that we can start via a Zoom meeting if you want to. I know we're kind of the COVID world, which brings me up to the QR code, by the way, at the bottom of the screen. Use that. We all know what those are. We can have you come into the office. It's up to you how we do that. But take advantage of it, because the people that do, they walk out of the planning session and they have so much more confidence.
Oh, yeah.
And they almost walk out of the office kind of light in their step, kind of like, hey, this is awesome, you know. And we love doing that for people. So call us at 844-944-7555. Again, 844-944-7555, or use the QR code in the bottom of the screen there and give us a shout.
Ryan, thank you so much. To the viewers at home, the phone number to call is on your screen, 844-944-7555. We have to take a very short commercial break, but don't go anywhere. When we come back, I'm going to ask Ryan his opinion on annuities, and would there be one that's right for you? Stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to On the Money. My name is Cynthia DeFazio, and I'm joined today by Ryan Wheless. He is the founder of Allied Wealth. Ryan, a wonderful show that we're having today, and obviously talking about, again, so many important topics, all circling around retirement. I have to ask you a question. People in the viewing audience, they're wondering about annuities, and if you think they're a good thing or a bad thing.
You know, an annuity it's a tool. Right, and so a tool is not necessarily a good thing or a bad thing. It only matters what it accomplishes, right? And so, folks, I will tell you this: you have a 9 out of 10 chance of being offered an annuity from a financial advisor today. So you better know what you're talking about. All right. There's 4 types of them. There's what's called the immediate annuity. The key word with the immediate annuity is pension. All right.
Okay.
You give an insurance company a lump sum of cash in exchange for a monthly paycheck you can't outlive. Well, if you step off the curb and get hit by a bus 2 weeks later, the insurance company keeps your money. There's no more money left. So people say, I don't want to put money into an annuity because I heard if I die, the insurance company keeps the money. And in the immediate annuity, that's absolutely factual, right? But let's say you live to be 110. If you live to be 110, that insurance company has to pay you until you die.
Yeah.
Right? So if you've got longevity in your genes, you know, maybe that's something you consider. But understand there's ramifications with it. The other ones are a fixed annuity. Once you compare a fixed annuity to a bank CD. And in fact, insurance companies built fixed annuities back just after the Great Depression because they saw all these people at banks, and these banks had all this money going into them in the form of CDs. So the insurance guys said, hey, you know, we do the same thing with the insurance or the banks do. We loan money out and use money and make money off of it. So they came up with a fixed annuity. there's really not much difference between the two, right? The last one you've got, the next one you've got is called the variable annuity. And you've heard Ken Fisher, I hate annuities. Well, Ken Fisher doesn't understand, I won't say doesn't understand, he doesn't talk about all annuities. What he's talking about, folks, is the variable annuity.
Okay.
And you'll find out real fast if Ryan Wheless doesn't like you, if he's offering you a variable annuity. I'm kidding, folks. I'm not licensed to sell one. I wouldn't do it to anybody, right? But in a variable annuity, Ken's right, because there's nothing you can do inside that variable annuity that you can't do in the stock market with paying, way less fees. All right? Because you're taking the same risk. The money inside the variable annuity is invested in, guess what, Cynthia? Mutual funds. Mutual funds, right? We've had that conversation, 35D1, right?
Yes, we have.
But they're invested in mutual funds. So why would I put the money in a variable annuity when I can just go to Vanguard and do this on my own and not pay anybody fees?
Yeah.
Right? So I don't believe you can accomplish anything inside of a variable annuity that you can't do outside of a variable annuity with way less cost.
Okay.
Right? And lastly is the one that you got to be really careful with, because to sell this one, it takes less time in the state of Texas to become a person that can sell this product than it does to become a massage therapist or a hairdresser. All right? And that is a fixed index annuity. Be careful, folks.
Wow.
With a fixed index annuity, the reason why I say that is a lot of the people that offer these programs, they're salespeople. They're not financial advisors. All right. And I'm a big fan of index annuities in the right place. For instance, a great alternative to bonds. Right. We know that bonds or interest rates are very low right now, and a typical way of de-risking a portfolio is to add bonds to the portfolio. Well, if rates go up and bond values go down, my de-risking mechanism is no longer going to de-risk the portfolio. Because the market goes down, the bonds are going to go down too, right? Because rates are rising. So a good alternative to bonds today has become a fixed index annuity. But make sure you're looking at one that doesn't cap your upside potential. Make sure you're looking at one that doesn't come with a bunch of fees and bells and whistles. And they're out there and they do exist. And part of what we will do for you, if that's something you want and you want to talk more about annuities, we will go and evaluate the marketplace. And if you're wanting to purchase one for income, the only thing that matters is for every dollar you invest, how much income do you receive? And if you're wanting to buy one for accumulation, then the only thing that matters is the index out there that gives you the most upside potential and the least amount of downside risk.
Ryan, thank you so much. I know we only have a minute left in the show this week. Any final words of advice you want to
folks,
give?
Just, thank you so much for being a part of the shows. Thank you, Cynthia, for being here. There's so much that happens behind the scenes that you guys and gals at home don't get to see. And I just want to let everybody know who's involved in that and how much I appreciate them. And lastly, folks, take advantage of the offer. The Complimentary Retirement Blueprint is there to help you, to help guide you, and help get you on the right path.
Ryan, thank you so much for another amazing episode this week. To the viewers at home, most specifically, thank you for spending time with us. That number to call is 844-944-7555. Any questions about how to plan your perfect retirement, Ryan and his team have the answers for you. Again, thank you so much for watching this week. Be safe, be happy, be blessed, and we look forward to seeing you back here 1 week from today. Take care.